For deferred compensation, FICA usually is due when compensation is paid. In the case of a non-qualified deferred compensation plan under Code Section 409A, FICA can be paid when services have been performed. This special timing rule for FICA on deferred comp benefits both the company and the employee. Usually the deferred comp is earned by an employee who's above the Social Security wage base. By opting to use this special timing rule, it may not cost the employee or the company any additional Social Security taxes. Of course, there's no wage cap for the Medicare portion of FICA.
As Barbara Weltman indicated, in many cases, the employer or the tax advisor does not discover the failure to pay FICA tax until many years after the deferred compensation has vested. It became standard operating procedure for the IRS to enter into a so-called closing agreement with the employer to make a retroactive payment of the additional FICA tax plus interest.
In the past, when a company failed to pay FICA up front and didn't discover the error until after the usual time to make corrections, the IRS had a correction option. The company could enter into a closing agreement to make a retroactive payment of the additional FICA plus interest. The IRS has effectively ended this correction option. Note to employers, get it right or else.
In other words, according to a recent IRS Chief Counsel memorandum, there could now be higher FICA taxes for those employers who do not pay up front.
Employers who don't follow the special timing rule for FICA on deferred compensation could face litigation from employees. A while back, an employer was held to be negligent in not applying the special timing rule, even though the law does not require the employer to use it.